Hey, real estate owners, if you are looking to tap into the equity in your properties, but you don't want to raise the debt and make your payments higher, well, do we have a solution for you today? We sat down with Michael Gifford, who is the CEO and co-founder of Splitero. And what they do is they help property owners tap into their equity in exchange for long-term appreciation or some of the downside risks that come along with that. So instead of getting debt for your property, instead of another HELOC, they actually take an equity position and ride the wave of that investment or that property with you. So if you're interested in an alternative way of tapping into the equity in your homes, make sure you check out today's conversation right here on Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Michael Gifford is the CEO and co-founder of Splitero and a career real estate expert who witnessed firsthand the lack of resources available to homeowners where they most need access to the value trapped in their home equity. Now, Splitero is a financial technology company that provides homeowners better options to access their home equity. Let's welcome to the show, Michael Gifford.
Nice to meet you. Thanks for having me on.
Yeah, nice to have you on as well, Michael. Great to talk to you. I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, certainly. I've been in residential real estate my entire career. I started out kind of back in the way when fix and flip was happening all over the country. We were buying a lot of houses at the foreclosure auctions. After that, I did a bunch of loans for investors that were flipping and building houses. And then really coming out of COVID, I was looking at the market trying to figure out what's the next best place to jump in. And I realized the same thing was happening all over the country. Home prices were going up, rents were going up. There wasn't a lot of inventory on the market, and people had a difficult time accessing all this equity that they built up in their house. And so we decided to start Splitero to make that easier for people.
Yeah, man, I appreciate that background. I love the journey. And you're right. That's one of the challenges I know investors face and homeowners face. Do you work with both homeowners and investors, or is this really tailored more for homeowners?
It's tailored more for homeowners. We do work with investors from time to time, but when you look across the market, just homeowners have trillions of dollars of home equity, and qualifying for a HELOC is difficult. People might not have the income, might not be the credit score. If you're not going to use that, then there aren't a lot of options, right? People look at credit cards or they have to sell their house, and neither is great. And so predominantly homeowners, but we do work with investors from time to time.
So what does Splitero actually do, and how does that help, right? Because you talked about that equity being locked up in the property, and to your point, typically your options are to, you can sell the house, which no one, you really don't want to do if you like the home. You can get a HELOC, that home equity line of credit, but sometimes that's maybe not available either or has some other repercussions. So what are the options, and how does Splitero come in to help?
Yeah. Splitero helps homeowners take a large chunk of that equity and turn it into cash, right? So they can receive up to $500,000. And in turn, Splitero shares in the share of their home's future value. So they get the cash now, they can pay it back whenever their first mortgage matures. So we do what's called maturity match. So if you have 22 years left on your mortgage, you have 22 years to pay it back. If you have 10 years left, you have 10 years left, no less than 10, no more than 30. So if you don't have a first mortgage, like a lot of people don't, then we're going to give you funds for up to 10 years. And then the interesting part about the product is the qualification process is really easy. So not like a bank where you have a debt to income ratio or you need a really high FICO score. We can work with people with as low as a 500 FICO score. It's pretty low doc if you've heard that term before. So we need a driver's license and mortgage statement, but we don't need tax returns and a bunch of other things like that. And then the biggest feature, which is really important for consumers now, even more so than when we started the company, is there's no monthly payments. So they don't make any payments on it until they're ready to repurchase. Um, and that is a huge feature for people, all over the FICO spectrum. If you have a lower FICO score or higher FICO score, adding another monthly payment is just not something anybody wants to do right now.
Yeah, I think that sounds like an amazing feature, right? And really, to play back what I heard you say is, this is a product that came out and is really solving a problem to help homeowners unlock or tap into some of their equity in their homes, right? So unlike that HELOC where it does add to, the payment, right? You're now paying that HELOC every month and, you're really stressing that property more. So you're adding more debt to the property already. In this case, you're not, right? You're really banking more on the upside. So as a homeowner, it's great because you get to access that cash today, but you're not making the additional payments on that money that you tapped into. And it sounds like it's more of an equity share into the future, not necessarily a straight debt position. Can you clarify that a little bit? Because I think most of our people are familiar with a debt position, right? So again, I'm getting another loan, a credit card, like you said, those are the typical options. I'm taking on some level of debt to access that capital. And that's what those lenders or borrowers are doing. Is it's an exchange of, okay, I've got this amount of equity. You're going to let me tap, 100K or whatever it is in exchange for this amount of, a loan or whatever the terms are that they're going to put on it. Sounds like it's a much different structure here.
Yeah, a little bit different structure. So we're going to give a homeowner a lump sum of cash up front,
Yep.
as you would receive with other products too. And then what we do is share in a portion of the home's future value. Typically, a homeowner might get 10% of their home value, and in the future, they're going to pay back 20% of that home value, whenever that is. Or we have a homeowner safety cap, which is also a protection so that they don't pay, a large amount or usurious rate. And in that scenario, it's 1999 annually would be the most they ever pay. So they're going to use that to compare to like a HELOC or another traditional debt product. But as you said, unlike traditional debt products where they're making a monthly payment and an interest rate on it, this doesn't have that. And so it's truly a share. If their home value goes up, great. If it goes down, we also share in that. And so you're truly, thinking about that future value of the house when we're giving them cash today.
Yeah, listen, it's an interesting model. Definitely a different approach that I think can open up the opportunities for a lot of homeowners. And I'm, naturally this show is really geared towards investors, so I'm thinking about our investors.
Yeah.
And if you're looking for capital to invest in a deal or to get going, right, get started building your portfolio. I mean, think about this, right? I mean, the ability to tap into the equity in your home to not add necessarily more debt to your home, which again is the challenge or the hurdle most people would have to overcome. But in this case, you're basically saying, hey, you got now an equity partner in the current home. You take that new equity that you're getting access to, this cash, and now you can use that to invest in a new asset. So for those folks who are looking to be creative and think through how do you build, how do you scale, how do you get more capital, it's just another strategy, another thing to think about. Do you have limitations on how the cash is used? Again, with the HELOC, I know sometimes if you're taking the money out and you're reinvesting in the home, great, they'll go up to a certain amount. But if you're trying to do a cash out refinance, that's where they're going to have those limitations. How does that look like with you guys?
Yeah, I think before I touch on that, I actually want to, one of the points you brought up is really pertinent here is, investors like homeowners also have the same problem, except there's kind of another feature there. They have a lot of equity in their investment properties right now. They also can only, in an investment property, usually support enough debt that they're getting in rents. So maybe rents haven't increased where they can actually go and get, additional debt behind whatever low rate mortgage they have. So then they have to look at like a DSCR option, right? And a lot of times you're going to then refi out that low, maybe 3-4% mortgage that makes their cash flows look great on their property. You're gonna have to refi that out with a DSCR loan that is going to be probably higher interest rate than they have right now, but it allows you to access that cash. So their issue is really the same as homeowners, right? They have a lot of equity that's trapped in those houses. So we do work with investors, and to answer your question, like the interesting part about this product is since it's not debt based and they're not making a monthly payment, their cash flows stay the same. And so they're able to then use those funds for whatever they like. There's no restriction on that. And we see people use them to buy another property or pay off debt here, credit cards, medical bills, student loans, whatever it is, or invest in a business, right? They'll start a business. We've heard people buying Amazon trucks for say, or other really interesting use cases that we support for sure. And so no, there's no restrictions to answer your question.
I love it, man. Hey, let's roll on the clock, right? You mentioned that you yourself were an investor and starting to build up your portfolio, saw the opportunity here as investors were, having these homes, building up the equity, but not being able to tap into it. Talk to us a little bit more about your own investing journey. What were you looking into? Were you investing? I know you're out in San Diego. Were you investing out in San Diego? Tell us a little bit more.
Yeah. So when I started here in San Diego, it was in 2009, and really you're in the middle of GFC. There's a lot of houses that are being foreclosed on for all sorts of reasons, right? You had all of the worst of, lost my job, the economy is going bad. I didn't understand what I was doing when I refinanced this house. And then you had the people that bought boats and BMWs and everything else, and, ended up with the rate changes and the financial crisis, and they end up losing their house. And so everything in between. So at that point, you could buy as many houses as you had cash for, right? There were so many things on the market. That quickly changed over the next 5-6 years, right? You went through kind of the foreclosure phase, then their short sale REO phase, then people started building ADUs, but it was tough to buy inventory. So then you started getting a lot of investors going direct to sellers or working with agents, which is kind of the status of things now. So it's still difficult to buy in most markets. And so during all of that, we're fixing and flipping a bunch of houses, we're buying well over 100 properties a year here in San Diego, and we're buying all the way up to Seattle. And so we're doing a large number of transactions, but it was difficult at that point because debt was really tough. So debt was expensive and tough to come by back in the day. And so it was hard to hold on to a lot of properties. So it was mostly fix and flip. As the market started changing, we were able to hold some of those properties. It was a little bit easy as debt costs came down. And then what happens is obviously as debt costs come down, then inventory also comes down dramatically and it gets more difficult to buy. And so what I was looking for in all of that is something that I could scale. The tough part about a fix and flip business is the construction, right? Construction is difficult. The more you want to do, the more, construction you're doing. And it's a tough thing to manage. It's a massive operation when you're doing 100 plus houses a year. So I was looking more for a product that I could scale, and I had experience lending money to other investors, right? And a lot of investors do that when they can't buy enough deals, but they might have cash. They might want to invest in other people's deals, and it's a pretty natural transition because they can understand what's going into that deal and whether they think it's good or not. But it's also a easier business to scale because you're not having to have boots on the ground, at all of these properties. And so really what I saw was these homeowners had very few options. So I was like, how do I get into that? And what does that business look like? And for me, it's really a marriage of the two. I'm buying a piece of equity in someone's house, but on the back end, it's more of an asset-based origination, right? It is what is the home value? What is their mortgage? What's the situation here going on title? And is this something that we want to invest in? And, where we're at right now with home values, low rate mortgages, people are locked in, as you described before. It's only given us tailwinds because when we started the company 4 years ago, the interest rate environment was still not changed. Nobody expected us to be where we're at today. And so now you have homeowners across the country that are still locked in with those low rate mortgages, and they don't really know what to do because if they go buy another house right now, their mortgage might double in price. And at the same time, things are really expensive. So they need to access the equity in the house because it's a massive savings account for a lot of these homeowners.
Yeah, listen, I think it's one, just your story, right? Just understanding a little bit more about how you got into this space and you were flipping houses from San Diego up to through Seattle, right? That's a pretty wide way to go flipping houses along the West Coast there. But you're doing up to 100 transactions a year. And I can imagine how challenging that must have been, managing those crews, especially all the way up to Seattle and down to San Diego. I mean, I can only imagine how much, how many phone calls and travel days you had to spend to kind of get your processes tight. So ultimately from that, you decided, you know what, this really isn't scalable because you still had to stay heavily involved and you decided to focus more on the debt side of it, the lending side of it, but really combining that with, as you called it, more, asset-based origination. And it's just an interesting approach. And that's one of the things that I think we're seeing right now is, real estate in general tends to move fairly slowly as far as the adoption of new ideas and new technologies. I mean, I've been investing myself for about 14 years. And I remember, when I first started, we were meeting residents, at a Starbucks to physically sign a lease. You know what I mean?
Yeah.
Like and it was, I'm not talking like 3 decades ago, but like, yeah,
Right.
in the early 2010s, that's how you did it. You met somewhere, you signed a lease, you looked them in the eye, you made sure they were who they said they were. And, that's how you did it. And like, I remember when the docu signs and the hello signs and all that came aboard. I'm like, well, this is great. Once I approve, I can just send an email. And it's obviously improved so much dramatically since then. And what you're getting at here is really a new way for homeowners to access the equity that they have in their properties, because that is one of the challenges, right? I mean, if you're a flipper, the problem is, once you're done with that home, the only options you have are to rent it out or to sell it, and if you rent it out, sure, you could try to do, a HELOC or, a recash or refi or something like that. But a lot of times, maybe you haven't created that much value, but it's a great home. It's going to appreciate over time. And these are the issues you run into, which is why, again, most people just go ahead and sell it and deal with the tax consequences later. You found a way to kind of really bridge the gap and say, hey, you know what, we want to be involved in the upside, but we need a way to scale as well. Can you talk a little bit more about the strategy of working with kind of homeowners as opposed to just being a hard money lender or working in more of the private money space?
Yeah. The private money and hard money markets are big, but working with homeowners, you're working in the biggest asset class in the world, right? Like if you just pull how much home equity is there in the US right now in single family, you're talking about 34 trillion. We're in 14 states. Those 14 states probably have 3 to 4 trillion of equity right now that we could help people get cash for. So you're talking about just massive markets. If you look at, like, say, the flipping market, I couldn't tell you exactly, but right, on average, there's around 300,000 flips in the US per year. That's a lot. It's a lot of homes and a lot of transactions for sure, but it's certainly not 3 to 4 trillion worth. And so, when we made the decision, we saw a massive problem for all U.S. homeowners of just not being able to access the equity in their house, and so we just attacked it, knowing it's just a huge market.
No, I love it, man. And I love the way you think about it, right? When you're in that hard money space, you're only dealing with real estate investors, right? Who are looking to flip a project at that time versus when you're dealing with homeowners, that's every house. I mean, I'm thinking about, think about the neighborhood you live in, right? Like how many flippers are flipping in that neighborhood? Maybe you get one or two, but typically speaking, you don't get that many flips unless there's an area that's starting to gentrify or getting repositioned. But homeowners are everywhere. So you have really an unlimited pool of potential clients or partners on these deals. So it's a great way to make sure that you have a lot of options and you're coming to the table with an option that most of them are not aware of or familiar with. What's been the biggest hurdle for you launching this business and really getting traction?
That's exactly right. Is you're talking about an archaic system where homeowners have only had debt options forever. And you only have those debt options if you can qualify for them, and qualification is only getting stricter, right? So it's harder and harder for these people to actually use those debt options. So that's the biggest hurdle, is most people haven't heard of this product. Most people understand the concept though, right? Like if you are trying to start a business, they, nobody would tell you to go get a bunch more debt. They would say, hey, you should raise some equity in your business, which is really what we're doing with their home. And so it has been, I would say, overall very well received once people kind of dig in and look at their options. Most people think I have a bunch of equity in my house, I can always go get a HELOC, which in reality, they can't, right? A lot of people don't have that 720 plus FICO and really, great cash flows and income to be able to support another, say, $2,000 a month HELOC payment. So they deal with the bank for 45 or 60 days and then end up frustrated and without cash. And maybe it's not, feeding their need, which is near-term debt or medical expenses or student loans or something like that. And so it has been an uphill battle. The interesting side of it is there's a lot more adoption of the product now. People have the ability to quickly understand their options. Like, yeah, maybe I could qualify for a HELOC, but here's two or three other things we should look at. And Splitero is usually one of those. And then what we see is kind of, a lot of people will qualify for a couple $100,000, but they want to try us out to see if they're real. So they'll, our minimum's kind of 50K. So they'll get 50K. And then 3 months later, they'll say, this has been such a great experience. I do need more cash. They'll come back to us. And they also, when you give people, on average, say $100,000 to $150,000, they tell their friends, I got this, they're real, right? They're not charging me monthly payments. And then you get a lot of people coming in saying, hey, I heard about you from so-and-so down the block, as you mentioned. And we want to access the equity in our house as well.
Yeah, man. Listen, it sounds like a great opportunity. I think to your point, with any newer product, awareness is going to be a challenge, right? And that's one of the things that you always see. I'm thinking about the legal aspect because I imagine when you first had this idea, you probably got some pushback from folks saying, one, is this legal? Two, I'm sure there is a way to make it legal, but even beyond that, again, with homeowners, not necessarily investors. Investors are always looking for a way to, to stack the capital and raise money and do these things. But most homeowners are probably a little more, cautious. And I imagine, especially if you're dealing with older homeowners, there's so much fraud that exists I'm not going to say lending, but just in general, where homeowners are targeted. Can you talk to us about maybe some of the concerns there and maybe some things that people should be aware of, especially if someone else is reaching out and how do you know this is legit, right? I mean, like it's so new that it feels like it could almost be, and I don't want to say the word, right, but it could be misleading, or it could be something that isn't what it pretends or says it is. So how do you deal with that?
Yeah. I think there's a few points there to think about. So there certainly is that aspect, right? We want to make sure that we do everything we can for consumer protection, not only of making sure that they fully understand the product, right? We talk to them through it. Our folks on the phone are licensed mortgage loan originators, right? So that's kind of above and beyond. They've gotten this license so they can explain these things, act in accordingly, and educate homeowners on what this product actually is and how it works. The actual product is very old though, right? It's an option contract. It's nothing new as far as real estate goes. It's not like this new thing that we invented. It's an old construct. And so that part is fine. But what we're doing is actively working with states to go in and we get our license. I've been a licensed mortgage broker and licensed loan originator and licensed real estate broker for a long time. And so our doc set looks a lot like you would see in your standard mortgages, right? For people to understand, we use terms and language and math that they can clearly understand in our disclosures. And what we also do is in a loan, you get this long amortization table, right?
Yeah.
What we do, because we're aligned with the home values, we actually produce a table that has different home price appreciation scenarios and different home price depreciation scenarios. So they can look and say, great, if I sell my house in 18 years and my home is worth X, this is how much I'm going to owe in both dollars and percentage. So they can clearly kind of understand and use that to compare to other products if that's what they're looking for. And so we try to go above and beyond to educate as much as possible, right? Make sure we're getting people on the phones and talking through what this actually is and how it works. And then on the other side of things, we're trying to work with states. This product right now doesn't have clear guidelines of like how you should actually be interacting with states as far as licensing and disclosures and procedures. And so we try to go above and beyond. But like you said, with a new financial product, it takes a lot of time. It takes time and it takes, when you're talking about the mortgage market and the real estate market, you have to get to like big numbers for state regulators to like really give you the time of day, right? The HELOC market itself is $250 to $300 billion of origination per year. So like there's a lot going on in that market that they're concerned with. And so we're trying to get in there here. We're trying to do our best we can. But right now, it's an unregulated market.
Yeah, so listen, great stuff. I mean, I love what you talked about consumer protection because it's important, right? There's so much going on. You've got to do your due diligence. You have to understand exactly how these different products and different opportunities work. And ultimately, just keep doing your research. Michael, for folks that want to learn more, they can check out your website, splittero.com. We'll put a link to that in the show notes. And before we transition, I do want to let people know, hey, if you're interested in investing in apartments and you're looking to unlock capital to do that, this may be a great option. But if you want to learn more about these deals and how to analyze these deals and what questions you need to be asking, we do have our free guide. It's 7 questions you must ask before investing in apartments. You can check that out at casmoncapital.com/7questions. All right, Michael, right now we're going to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the mastermind button today. Give me a failure or an apparent failure that sets you up for later success.
Failure or apparent failure. I think that while you're investing and while you're doing deals, you learn more from the bad deals that you do than you do through the ones that just, go like clockwork. And so I would say probably pretty early on, I bought a deal. It was in mid-construction. The developer walked away. The guy called the note. I bought the note from him, walked in, learned a lot about, buying something mid-construction, all the stuff that you don't understand when you buy something like that. And so I learned more from that deal than probably, dozens of deals that just went like clockwork, like they do on the pro forma.
Give me a digital or mobile piece of technology that you will recommend for our listeners.
I am constantly on the go. And so I tell Siri to make me notes for everything. I say, Siri, make me a note, describe whatever the note is, and remind me when I get home. So as soon as I get home and I sit down, it all just pops up on my phone. It makes it really easy to keep track of stuff while you're on the move.
Give me the book you've recommended or gifted the most in the last year.
Oh, the book that I recommend or gifted the most. I do a lot of audiobooks. I would probably say the one that I've recommended the most would be Comfort Crisis. If you haven't read it, it's a great read and it's a great listen as well.
All right, Comfort Crisis it is. Hey, what's a daily habit that helps you stay focused on your goals?
I think self-care is pretty big. So I try to work out. If I'm ever in a place where I'm mentally blocked, I'll go outside and walk the dogs, or try to get a lift in. I think that the clarity from riding Peloton or lifting or just even getting outside and walking around without headphones in is what's often needed to set me up well for my daily goals.
What's your number one insight for, and let me say it differently. Give me your number one insight for scaling a business.
Hyper focus. When you are starting a business, you're going to get pulled in a million different directions. We try, even today at Splittero, 4 years in, to be hyper focused on 1 or 2 goals for all of our teams. So right now we have 2 goals that we're working on across the org. And so not being pulled in different directions and distracted will help you scale faster than anything else.
All right. And you're out there in San Diego. Give us your favorite place to grab a bite to eat.
Favorite place to grab a bite to eat in San Diego? I would say Taco Surf down in Pacific Beach. You have to get a breakfast burrito from there if you come to town.
All right. Sounds like a great option. Well, Michael, appreciate your time today. You talked to us about kind of your background, being in a flipping space, man, and flipping all up down in the West Coast from Seattle to San Diego, and really recognizing that, man, this is really hard to scale. Looking at the other side of the business in the mortgage space, having kind of your license in it, so you understood how it worked. And you recognize that there was a gap between the equity that homeowners had in their homes and being able to tap into it without adding more debt to their properties. And that led you to launch Splitero. And today you help those investors or homeowners unlock that in exchange for equity in the upside and potentially downside in their homes. So I appreciate you sharing that, man, just giving us some great tips and insights on ways to think about it, but also just to protect yourself in that process. So if anyone wants to learn more, check out splitero.com. Michael, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.